You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 3 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuickStrike, options pricing and analysis software. QuickStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuickStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuickStrike is the perfect addition to your trading toolkit. Learn more about QuickStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuickStrike1. That's QUIKSTRIKE1. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that funky tune means it's time once again for TWIFO, This Week in Futures Options, a program here, as the name implies, on the old Options Insider Radio Network, where we break down the week that was and indeed still is from a futures options trading and development and volatility and trends and all sorts of other perspectives. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. If I sound a wee bit different, it's because I'm not beaming in from the frozen 1-degree Options Insider studios in Chicago this week. Actually, no, beaming in from a little bit farther south. The southern studios are in effect this week, so if I sound a little bit different, that's why. It's also why I apologize if you tried to tune in to our live stream. There won't be any live streams this week, or indeed not till there will be one next week for this program. So later next week we will have live streams going again, but not unfortunately for this week. So you got to go the old-fashioned way, getting it on demand wherever your finer podcasts are available: iTunes, TuneIn, Stitcher, including Pocket Cast. We've been up there for a while, but now they made it even easier for us to share the direct Pocket Cast link with you. So if you guys want to just add us via Pocket Cast, I know I love Pocket Cast. It works across all devices. You can do that as well. Also via our own mobile app available for iOS, Android, and the beloved Fire OS. And, of course, however you listen, streaming live or after the fact, make sure you hit us up with those questions, those comments. You guys are the reason we do this program, so get those questions in. We love to hear from you guys. And joining me on the old program, as usual, my cohort, my partner in crime, my friend/cohort/nemesis, Mr. Nick Howard, the founder of Bantix Technologies and creator of a little platform we like to use around here quite a bit called QuickStrike. Mr. Nick, welcome back to TWIFO. And how are things in the, shall we say, 30 to 40x colder region where you are right now?
Well, it's actually balmy in comparison to the way it was earlier in the week, so it's not so bad. But I'm just getting ready to hunker down for the weekend since it's supposed to be pretty awful. So get my movie list, get my beer list, and we'll go from there.
There you go. Netflix and chill, or in this case, maybe Netflix and warm up a little bit. I don't know about you, but not to make it too much of the weathercast at the top of the show, but I'm just mentally not ready for this degree of winter this quickly. Usually people think Chicago, it's a frozen tundra, but actually it's been pretty nice the last few winters. And to have it this hard, this fast in December, it was a good time to get the heck out of Dodge. Let's just put it that way. All right. And with that, let's dive on into our hot products, our interesting trades, what's catching our eye this week. Going to kick things off, Nick, in a different realm than we typically do here on the program. In fact, I don't think we've ever touched on this before. It's kind of an interesting corollary to a product that we like to talk about on this program quite a bit, which is the energy complex, in particular WTI. Well, there are, of course, other facets to the energy complex, including Brent. We mostly talk WTI over here because that's one of the big products here domestically. It's also one of the big products that goes up over there at CME. By the way, if I forgot to mention at the top of the show, if you want to follow along with the reports Nick and I produce, head on over cmegroup.com/TWIO this week in options. I don't know why they leave the F off. I guess the F is implied over there. Either way, TWIO, this week in options, you can generate all the reports that Nick and I are talking about on the program, all on your own and all completely free. So take advantage of that if you haven't done so already. We're going to kick things off, though, Nick. Before we even get into the hot trades in WTI itself, some interesting stuff lighting it up this week in another product, again, that we haven't really talked about so much before. Again, Brent's out there. It's very active. It's very hot. We mostly talk WTI, but there also is an active spread trade between the two. Because let's face it, they're different products. They trade differently. Brent mostly in the international spectrum, whereas WTI, as the name implies, West Texas Intermediate, it's mostly a domestic product. So they have different shipping, different logistical regimens behind them. And there's, as a result, a bit of a price differential built into them because there's limited arbitrage opportunities. There's shipping problems, logistical challenges. So there's always an interesting spread between the two. But this week we saw some interesting chatter coming out of some changes in the overseas tax structure, which may make the differential between WTI and Brent a vastly different, if perhaps vanished altogether, which is very interesting. As you might imagine, when we see that kind of talk, Nick, we see a lot of activity out there in the WTI Brent spread contract itself. So very interesting stuff. In fact, kicking it off this week with our crazy trade of the week because this one was just kind of nuts. And also because we don't really talk about this product quite a bit. Nick, I know you were watching it quite a bit, so I'll let you go into it in a little bit more detail. But a lot of activity out here in Dees and all the way out to farther out in Dees as well. A lot of opening trading as well. People coming in and pretty much just diving into this spread pretty much wholesale. That said, Mr. Nick, I know this one's really been on your radar for most of the week. What's been catching your eye out here? Just a crazy week, hitting some historic levels out here for the old WTI Brent spread trade.
Yeah, so this is an interesting one. It got brought to my attention by someone, really. I wasn't out there really looking for it, but somebody had asked a question once some of the early volume took place this week. But, you touched a little bit on the difference between the WTI and the Brent. I guess a lot of it's got, and again, you and I, as always, we're learning as we go along, right? We don't necessarily have all of the answers. Believe that or not, we don't have all the answers every time we're
Speak for yourself, sir.
Oh, that's right. But, that price differential used to be flat, then it existed because of, like you said, WTI is a little bit landlocked. There was some overproduction there, which pushed the price down, and then the inability for it to get out of its area in the U.S. down there, where in the location storage down in Cushing, Texas. So, now there's that spread that exists. But I believe that there was some talk this week about possible tax on foreign oil. So there was some speculation that the spread would move toward parity, which basically means that, where they're even with each other, right? So what we saw, and this is, I think we really do have to, this is probably the definition of our crazy trade of the week, like you said, right? Because it's way out there. There's some speculation to it. It's not necessarily a short-term play by any stretch of the imagination, right? It's when you're talking about doing, if we look at it just right now, most of what we're talking about took place in the June of 2018 and the December of 2018 contracts for this WTI Brent spread option product. And let's just say the majority of it took place in the DEES 2018 contract. So you're looking at a contract that has over 680 days to expiration. So there was a lot going on. There was a lot of price points that traded in this trade. So let's just look at it. So I did a little checking around, and I thought, boy, I hadn't seen. Well, when you don't pay attention to a product, then you got to go out there and look and see what's going on. So this isn't the highest open interest that this product has. Back in 2013-14, there was a higher open interest at this point, not necessarily at this point in time in the cycle, but just a high open interest in general. But I'm going to guess that after we see what happens with this spread, and as people get their attention drawn to the fact that this is out there in trading, I bet you we're going to push the limits of that record at some point in the near term. But like we mentioned, we had opening trades in the June 8 and the December 8 contracts for the 0.0 strike. So when you're trading future spread, right, you can have negative strikes. So that's kind of the weird thing. A lot of systems aren't even really great at looking at that stuff, and you have to use a special model. Typically use something called the Bachelier model, which lets you do pricing on strikes that are negative. So of the roughly 52,000 and change that traded this week, through Thursday, right? Because we don't know how much open interest changed with today's trade. And today we saw 10,000 more trade at a price of 65 cents. So that's about what, Mark? 65.65 times 1,000, like 650 bucks, right? So another 10,000 of those traded today. But prior to today, the closing open interest for last night, we had 40,000 new position here. So that's a massive increase from where it started this week. There was 250 contracts open when we started this week in the December contract for 2018, and now there's 40,250, not including today. So just lots of volume, lots of price ranges traded. So it started out trading at 0.2 or 20 cents, moved all the way up to 70 cents on Tuesday, traded back down a little bit, and then traded up again to 65 today. So, this is I have a number in our docs. It's a wrong number because my volume was off. But you're talking in the 20 million range in premium that was spent on this. So it's that's for a single strike that we're talking about. That's certainly what we would categorize as a fairly crazy trade of the day. And we also had some openings in this parity strike or this zero strike in the December 17 contract, where 1,000 traded on Wednesday. Okay, and then like we mentioned, there was some June that went up on Tuesday only. 6,000 traded, but 5,500 of those were opening. So there were some people thinking about this, and it's always interesting to me, Mark. We always talk about it, why they pick these certain expirations. So clearly somebody's thinking out there a bit. Maybe they're looking at what the relative premium is to the amount of time, but they're basically making a almost 2-year bet, a multi-million dollar 2-year bet on the fact that this price is going to move toward parity. So pretty interesting. I thought that other thing that we should mention, there is not a tremendous amount of open interest in that zero strike, right? So that's WTI minus the Brent future. So that gives us a zero price, but there's open interest in what we have in quick strike that we're noticing in the February contract of 2017, the December contract of 2017, and the June and December contracts of 2018. So again, as we kind of add to our checklist as we go through this, as we go through the show every week, we'll try to keep an eye on this and see if anything new's happening as we go along. But if you get a chance, go out there and look at the TWIO report and see for yourself where a lot of this action's taking place and how this really changed the current open interest levels in that product. I mean, a 50% increase in open interest this week, 56,000+ additional open contracts just primarily out in that December contract.
It's interesting when such big paper going up in that spread that spread contract is, of course, going to drive paper in both of the mothership contracts, the Brent contract, and indeed the WTI, which is where we turn our attention to now. It was another banner week out there in WTI. Overall open interest up about 150,000 total contracts, so over that 2 million mark, up about little over 8% actually this week. The net futures settling out a little bit, slightly higher on the week. We're still firmly in that mid 50 handle, right around the 55 range or so for most of the WTI contracts. Maybe a little bit farther, a little bit more as you go out, a little bit less, but right around that 55 strike or so. So kind of unched a little bit higher from where we were this time last week. What isn't unched, what it continues to get crushed, and I think one of the interesting stories going forward here in the futures options world, and indeed the volatility world these days, Nick, is just the continued destruction of volatility out here in all things crude. I mean, WTI vol is just getting annihilated. We talked last week on this program, indeed talked on the Volatility Views program a bit as well, about how it seemed like crude had established a floor for volatility for the better part of this year, and certainly had rebounded off that floor multiple times during the year. And it, depending on how you measure it, at the money vol out here in the big WTI contracts, hovering right around a 30, a little more, a little less, depending on where you're looking out there in the term structure. You could also look at some of the broadly followed VIXs of crude, whether it's the USO VIX, OVX, or the WTI VIX, OIV. Either way, both of those have hovering around a 30 right now as well, which is fairly low for both of those products. I mean, if you look back at the better part of this year, most of them, when they hit about a 35 to 37 range, they seemed to bounce. That mean reversion that is latent to volatility would seem to kick in, and we'd see a nice run back into the 40s, maybe even into the 50s, as we saw a couple of weeks ago with the OPEC deal when OIV and OVX both spiked into the 50 range. Now they got back into the mid 30s. A lot of people expected them to maybe hover there or perhaps revert. Instead, we've seen this continued crushing of volatility as, again, off a couple of handles again this week. And we're flirting with the 30 level, which we haven't seen in some time in OIV or OVX, or even in the front month vol out here in WTI. So it's kind of been an interesting story to watch. Certainly, perhaps an attractive tale if you're on the premium buying side of the fence, Nick. Not so much if you're out there trying to harvest some income out here in the big WTI contracts, but we'll get more into that in a second. In terms of what was lighting it up, again, it was maybe perhaps not surprisingly, given the action out there in the Brent crude spread and some of the strikes and time frames that Nick was outlining, not surprising that yet again it was front month where the action was. 52% of the volume this week come in that front month contract out there in good old WTI. And where the action was, you're saying to yourself, hey, kind of an unched week in the futures, kind of a crushing in the vol. What was lighting it up this week? Was it the calls? Was it the puts? Well, it was the calls. Number one with the bullet in terms of the 53s, where most of the action was actually are out there in Feb now. So the Feb 53s lighting it up to the tune of nearly 40,000 contracts this week, just a tick under 39.5 to be precise. The lion's share and pretty much all the strikes here in the front month came on Wednesday with about 17,000, nearly half of that 39,000 coming on Wednesday, and another good chunk coming on Thursday with about 10,000. Number two was the 55s, the doubles out here with about 30,000 and some change going up this week. Number one day again being on Wednesday with about 13,000. Again, nearly half of that 30,000 contracts coming on Wednesday, and then the rest spread out. Bunch on Monday, and then again on Thursday the rest of the week. Kind of anemic. And then number three, a bit of a tie between the 50 puts out there and the 54 calls, both with about 22,000 contracts and change. 13,000 of that 22 coming in the 54 calls again on Wednesday, with the puts fairly more evenly spread out throughout the week. Both of those coming in at the 22,000 level. Then it drops off a bit again, 48 puts and things. So if you're wondering if it was puts or calls that were the order of the day this week, once again, it is the calls, which kind of leads to an interesting development out there in the skew as well. I was just playing around with the quick skew And Nick, I've said before how much I love playing with that. And you guys, listeners, if you haven't played around with that yet, I'm not sure if you can't access it through the Tweo page. I believe you have to log in to QuickStrike there, which again is free, and you should have access to that quick skew, I believe. If not, it's worth upgrading from the essentials to get access to, because I play around with it all the time. And it shows you exactly how much the call wing is evolving versus the put wing. And it's kind of interesting to watch out here in WTI. We've said this before. It's a bit of two different narratives developing out there depending on where you're looking in the term structure. If you look a little bit farther out, like to mid-2017 and beyond, it's the calls coming off, the puts getting a little bit of a bid, and that's why we're seeing a bit of an increase in the skew out there, about half of a point or so out there. But if you look in the front month where a lot of the action is, it's actually a sharp bid to the calls, which is not surprisingly given what we've seen all the action in the calls, and that bid has been so aggressive in the call wing, and the puts kind of unched to coming off a little bit. We're seeing the skew up there as well, but for an entirely different reason. So it's kind of interesting to see how that plays out, Nick, and how the different levels, the different areas of the term structure, the different activity they're in, how that plays out with the same thing. If you just were to look at it on the surface, you'd see skew kind of up across the board and maybe assume it was the same thing playing out in all the months, when in actuality, it's two very different stories playing out, but the net result, if you just look at the pure skew numbers, kind of the same. So interesting stuff out here, a lot of stuff to talk about here in WTI. What was catching your eye this week in the mothership WTI contract, in addition to all the spread stuff going on out there this week, Nick?
Let me uncheck my mute button there. I think what I think we got to point out is, if we, you mentioned the majority of the open interest in the trade occurring in the early part of the curve, like we always talk about, right? So most of the stuff's going to happen in the front part. But as we, one thing we always touched on is that outside of the early contracts that are in the cycle here, we tend to see volume in the June and the December contracts as well. So if you go out here and look in the June and December contracts, and what you can do when you're looking at the report, you can click on that expirations button and you can limit your view to so right now we're going to default to that first group. So you're going to get about 12 expirations. But if you want to get rid of those ones that with a little lower open interest, go to that expirations menu and check those off. So I like to compact it down to 5 or 6 of them. But if I go out to the June contract, I can see, we had volume this week, roughly almost 80,000. Same thing in the December contract. But if you look at that line, you had a change in open interest. The high open interest change this week, without including today, is the 70 strike. And the same thing out in December, it's the 75 strike. So if we go look at the details for that June contract, we're going to see that there was trade in the 55, 60, 65, 70, 68, 75. So there was opening trades and a fair amount of stuff for that far out in those higher strikes. So people are still a little bit biased when we start to look at further out on the curve. We're seeing a lot of call buying, and if you look at those put call ratios for the volume for this week, as well as for the open interest in general, there's a bias to the upside. And if we go out and look at the December contract, we're going to see that there was trades, the 60, the 65, the 70, 75, the 85, the 90. Okay, so we have, and the 90 had some openings, not a lot, but stuff out there. 85, of the 5,200 that traded, probably got about half of them are openings. 75 strike, about half of them are openings. The 70 strike, a third of them are openings. So, you're seeing, now this could very easily, Mark, be tied to some of this WTI trade as well, because if they feel like Brent's going to get pinned a little bit and WTI is going to move up, those are people maybe potentially taking a play. And we don't have a very active Brent option market on the CME Group exchange, but you don't know what people are doing on the other exchange to maybe sell those upside Brent calls. But we can take a look and maybe discuss that next week and see what we can find out in terms of anything that's happening over there, or even in our Brent contract. But yeah, there could easily be people that are starting to make some plays out in those farther dated expirations. In fact, for kicks, let's go out here and look at the June and the December 2018 contracts, see if we have anything interesting out there from. So if we go out to December 8, here's some interesting stuff, and I should have looked at this a little bit sooner. So out in the June 8 contract, we don't see, what do we got? We don't see too much call activity, but if we look at the December of 2018 contract, we see that there were trades this week the biggest trade is in the 85 strike and a 1200 lot, and on Wednesday with 1,000 of those being on opening, and some trades all the way up to the 125 strike, 110 strike, 100 strike. So you don't know exactly how the spread versus the regular market plays out, but interesting things to look there are. Take a look at the further out expirations. And also, if you just kind of run down this volatility column, you're going to see that the term structure is, you got Feb, March, April are in the 30s, and then you have May and June, and then these 2017. I mean, vols on the term structure, vols looking like it's getting pretty cheap, so it's really pushing it down as we go out there. So I don't know if you have anything to add to that from a volatility standpoint from your vol view show, but that's definitely something interesting and something to watch.
You're right. It has been interesting, and I would be surprised if all that call activity, all of it happening on Wednesday across multiple strikes, there's no way it's not at least somewhat related to all that spread activity going up, because you're right. There has got to be some hedging activity, some locking in activity in the big mothership contract, and such a spike of activity across all those call strikes in the front month and across all of them coming on Wednesday. I'd be surprised if it wasn't at least somewhat correlated to all that spread going up in the Brent and the WTI. Speaking of correlated with activity, Nick, I think we'd be remiss if we didn't at least touch on the rates complex this week. We know our friends, Ms. Yellen and company, got together for what is now effectively their annual raise in December. And we saw some commensurate activity as a result. I'll let you get into the lion's share of this because you are the former Eurodollars guy. So this is kind of right up your alley. But we did see a lot of activity out there in Eurodollars. Of course, when you're talking Eurodollars, it's just a different beast versus just about anything else we talk about here. We just talked about a 2 million plus contract week in WTI. You're talking 10x that out there in the Eurodollars, about almost 21 million contracts. So it's up about 2% again this week, nearly 400,000 contracts. So just an order of magnitude different in terms of how much paper goes up out here. That said, it's a different story when you're talking about where that paper actually goes up versus what we saw in WTI. In WTI, it's a primarily front month type trade. Out here, at least this week, out here in the Eurodollars, it was actually farther out in June, I believe, where the lion's share of the paper, about a third going up this week, kind of evenly split between that June and like March. So maybe Nick, you can speak to that a little bit more as well. You spent some time out there in that pit. Is that typically how this product breaks down? Is it usually that far out with those kind of maybe the quarterly months kind of leading the charge, or is this kind of more of an aberrant week because we saw Miss Yellen and her company out there sticking their nose into the pie?
I think what you're going to see in the Eurodollars, it's kind of it's an interesting trade, because if we were talking 2 or 3 years ago, you would have saw that a lot of the activity was out in what they call the shorts or the mid curves, and those are options. Those are short dated options that are trading on not necessarily the first part of the Eurodollar curve, but like the second, third, and fourth years. And a lot of the reason that was happening is because most of any kind of rate change activity was going to occur not in the next year, but out in the 2, 3, or 4 year mark. And we're starting to see that 2, 3, or 4 year mark is now here, right? So as the Fed started to take action again, you saw a lot of what was open interest in those mids, or the latter part, the 2, 3, and 4 year parts of the Eurodollar curve. It got pushed back up to what we call the whites, or the front part of the curve. So as there becomes more activity in a particular term or place of expectation where these rate changes are going to occur, you're going to see the open interest sort of fluctuate between the two. Now, you're still seeing a tremendous amount of activity and open interest in that in the front part of the curve, because that's where the action is going to take place. But you're also seeing, that's the great thing about the Eurodollar market. Each of these pieces of the curve almost trade like distinct products, right? So we had this short-term expectation, hey, rates are going to change now in December. So you saw a lot of activity in front, but then you also saw a lot of things where they're talking about what's going to happen next year and the year after that. So they're already speculating 3/4 point raises next year and 3/4 point raises in 2018. So you're immediately going to see activity in those parts of the curve. And that's the really nice thing about the Eurodollar product, is it lets you play in those parts of the curve. And it's almost, they're very distinctive. They're almost like separate products. And that's why in Quick Strike in particular, we treat each of those things. So you can go out there and look at a term structure for each part of that curve. So you have the whites, which is the front part of the curve, and then you have what you call the mid-curve reds, greens, blues, and golds. Okay, so those are on the different parts of the curve. So it's like the 1 year, 2 year, 3 year, and 4 year. They even have a 5 year mid curve. So you can go out there and see what those term structures look like. And the reason they're separated out into their own term structures is because they have their own set of short dated options on the longer dated future contracts. So there still are long dated, really long dated quarterly. So, 15 month, 18 month, 21, 24, 27, et cetera, months out, all the way out to 4 years. So you have some really long dated stuff, but you have short dated, January, February, March, April, May, all the way through December, short dated up to 1 year options on those parts of the curve. So they are really distinct. You can really play with them. You can do spreads between the long dated and the short dated stuff. So I suspect you're going to see just even more activity across the board. So I think that, when it's really stagnant like it was a few years ago, you saw a lot of the open interest sort of centered in these mid curves. But now if you go out there and look and you see what the curve looks like, you're going to find that, and I could even sort of take a look at that and to justify that response, you're going to see that a lot of the open interest is just going to be pretty much everywhere. So you're going to see a lot of it in the front because of the activity that's happening, but you're also going to see that it's pretty steady across the board. So yeah, if I go out here and I turn everything on and take a look at what the open interest looks like, I'm going to see that, we have some massive open interest in the white contracts, but you also see really good solid open interest in like the 2 year section for the options itself, as well as in the 3 year section. Okay. So there's good trade out there. And I think you're going to continue to see that kind of trade in this market, especially. And I think what you saw too in the, at least I believe, it was a pretty big sell-off, even though everybody really was thinking that, they knew the rate hike was going to come almost with certainty. But I think some of the hawkish rhetoric then that took place, saying that we're going to do 3/4 and 3/4, I think that gave people some push to go to push the futures down even further. So what's the good part about that? Right? There was some more activity, so there was some more volatility than maybe people expected, and that volatility or that talk that the Fed had is going to lead to the futures coming back, right? So there's a good chance that the Eurodollars are pretty famous for getting oversold and then coming back. So you're going to see some activity in there. That may not necessarily be good for volatility coming back up to where we were, but there is some opportunity there to get in and and get some trades and look for some again, like I say, something you get oversold, you get a chance to buy some puts and hedge them, do it, or you can sell some calls and hedge them because you're going to get that vol is going to get pushed down as you move back toward it. So going to be a great market to trade here. Obviously, lots of liquidity. I mean, the fact that the open interest is, what does it say, 45 million is the open interest in the Eurodollars? I mean, what more can you ask for, right?
Yeah, it's pretty crazy numbers. One thing we know about Miss Yellen and company is they're never hesitant to try to keep themselves in the conversation, saying, pay attention to us going forward. So they left us with that message yet again here as they close out the year of yet another. A lot of will they, won't they, mostly won't they dance from the Fed. We'll see what the future holds. Meanwhile, though, it's time for you guys to make your voices heard on the show with some quick futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to the Futures Options Feedback, as the name implies. And as the man said, this is the portion of the show where you guys get to take the reins with your questions, your comments, your insights. Hit us up at social media, at Options, I should say, on Twitter and on Stock Twits, The Options Insider on Facebook. Hit us up on the website, theoptionsinsider.com. You can find the website feedback format there, as well as, of course, all of our social media outlets. You can click on them as well. Or hit us up the old-fashioned way, questions at theoptionsinsider.com. Or hit Nick up during the week as well. He wants to hear from you guys as well. He'd love to answer your questions at QuickStrike1, QuickStrike1 on Twitter. And if you're not following him, you should do so already because he tweets out a lot of great graphs and charts throughout the week, most of which we will retweet. So if you miss them, you follow us, we'll get you. But follow Nick because he's got a lot of good nuggets and pearls of wisdom there throughout the week. You can always ask him questions, too, about some of those charts he's tweeting out all week long. Speaking of questions, we got to pay off a couple of them here, our questions of the week. We asked you guys last week, what did you think was going to happen with OIV, with WTI vol coming out at the end of the week? At the beginning of the week, it was 37 for last week. We said, where's it going to go to the end of the week? The vast majority of you, almost over half, the leading candidate was about 43, almost 44%, saying it was going to be above 40. Finished the week above 40. Well, we all know how that worked out. It finished the week, I think, right around 33 or so. Certainly, most of you picking a little bit of a rebound for crude vol. Didn't see it last week, and certainly didn't see it this week with OIV closing out the week right around 30. Maybe 30 and a half or so. So who knows when that crude vol rebound will come. What we know from looking at the skew, it's going to have to come probably with a decent sell-off in WTI. And at least from the paper we outlined this week, seems like the bulls are back in force, at least for the time being. So don't look like we're seeing any aggressive sell-offs priced in anytime soon. This week's question of the week, a surprisingly active one, Nick. So I kind of want to get your thoughts on this one. We asked people out there, financial advisors that represent the last options frontier. What level of options knowledge do you expect from your advisor? Now, by advisor, we meant financial advisor, but it could also mean your CTA, your commodity trading advisor. Again, you'd expect a little bit more derivatives wherewithal from those guys because they're playing mostly in futures. But the same question applies, and we gave them 4 choices, Nick. We said, hey, one, or we kind of termed it first. We termed it in kind of the levels of brokerage approval for options trading. So we gave them level 1, level 2, level 3, or 0, which is none. I'll do it myself. Or level 1, you expect your advisor to be able to at least buy puts and buy calls. Or level 2, they understand income, writing options for some income, and maybe they understand the impact of volatility on their options trading. Or level 3, you want a die-hard options specialist. And this one, Nick, we thought this would be a little bit more of one of our more nuanced questions. This one's came roaring out of the gate with a lot of interesting results, and here we are coming towards the end of the week, and a lot of surprising results coming in on this one. I'm curious, Nick, what is your vote for this? What do you think? What do you think should be winning? And then what do you think is actually winning our poll? What do you think people are actually voting for?
So really, I guess it is what do I think their level of knowledge is, and what would I expect?
Yeah, what do you think? So, what do you think the answer should be in your own view? And then what do you think our listeners? Remember, our listeners are down the rabbit hole a bit from an options experience level, so keep that in mind. But what do you think they're actually voting for as well? So 2 answers I expect from you, sir. Put your thinking cap.
Well, I would think that me personally, I probably wouldn't expect more than a level 2. Option specialist is tough because I really believe, and this is not just me, because I traded, I really believe unless you were, I'll even go as far as saying in the pit, okay? And I know there are people who've never been in the pit who traded, but unless you were really in the thick of it, and maybe we'll include the desk guys because I don't want to make anybody mad, but that you really see what's going on when you're in the thick of it and you have to make markets and you have to respond. So I think there are a few option specialists, and I wouldn't even put myself at level 3. I'll put myself between a 2 and 3 because I haven't been in the pit in a long time. But I wouldn't expect that because that's unless you get guys that are coming off the floor, going off, or guys coming off the floor that become financial advisors. I would like to see that they'd be level 2 income and volatility, but my guess would be that most of them they know how to buy puts and calls. That's my guess. I would like to see level 2 because I think it's hard to get to level 3 unless you have some really, really good practical experience. But somewhere between 1 and 2 would be great, but I think you're probably more oriented towards 1.
So your pick would be 2, and you're thinking 1 is winning our poll. That's what you're saying.
I'm okay. I'd say that let's see, what level do you expect? I think they would expect 2. I think that's going to be winning your poll, but I personally think most of them are at level one. Let's put it that way. I would expect most of you people think that think it should be level two.
It's been a contentious one, and I've actually had a chance this week to put it to a lot of our different hosts on the different shows on the network, including our advisor show earlier this week, because the response has been kind of surprising. I myself wasn't sure how our audience would break down. Like I said, we speak to a more sophisticated audience on the options side of the fence, so I wasn't sure if they would all say we want a specialist and go that way, or perhaps they all say, the heck with it, I'm better than any guy out there, so I'm going to do it myself. So I wasn't sure if it would probably break down between those two, and that's kind of how it's breaking down right now. About 43% saying none, I'll just do it myself. And then about 26% saying they want an option specialist, a level 3 guy. So not a lot of love for level 1 or level 2, about 16% for level 1 and 15% for level 2. A little bit surprising. Also interesting kind of breakdown across the different spectrum of our hosts on the network, Nick. You were saying probably level 2. You were being kind of generous, saying it's hard to find a level 3. Actually, the guys on our advisor show were in a similar boat to you. They were saying it's kind of hard to find a level 3 guy out there, so reasonably you can expect if you get level 1, you should be, it's good. Level 2 is kind of what probably maybe the most you could reasonably expect from most guys out there. So they were a little bit more charitable than I thought as well. Then I got some of our guys on our shows like Option Block or Vol Views or others where they're a little bit more on even the harder core spectrum, and they thought if it was anything less than level 3, you were just wasting your time. So a lot of different viewpoints on that. We still, this poll runs through the end of the week and the weekend, so you guys have a couple more days if you haven't voted yet. No, a lot of you already have. But some surprising results and a surprisingly heated poll for something as relatively comparatively staid, you'd think, Nick, as financial advisors. But apparently this is a very contentious issue. So we'll have to pick your brain on some more different levels of this going forward. Interesting stuff. Let's move on to some other ones here quickly. We got a question here. Since we're talking Fed here, Nick, this one coming in from Vegan, kind of a top level, I guess almost thought kind of question for us here. He writes, you guys mentioned the Fed with regards to equities. Should the Fed really care about what the market is doing? Again, not an options question, but more of a kind of a 10,000-foot perspective question. I guess this kind of goes back, Nick, to kind of the mantra, the reason that the Fed exists. Obviously there's different viewpoints on this. Some people think the Fed should be a completely independent body from a political perspective. Some think there should be maybe the Treasury Secretary should have a seat on the Fed governors. Others think the Fed should be deeply in tune with what the market is doing. Some others think that it should be completely ignore what the market is doing. I think one of the Fed governors infamously or perhaps famously, depending on your viewpoint earlier this year, said they don't even have a Bloomberg terminal in their office, kind of implying he doesn't care what the market is doing. I'll give you my own 2 cents on this, Nick, then you can kind of weigh in. Again, it's a contentious issue. I don't think the Fed should be, watching S&P day in, day out to try to kind of keep that kind of level of detail on it. They should have a broader, larger, more macro view. That said, I would like to see a little bit more, I think, market savvy and wherewithal there on the Fed Board of Governors and in maybe in the actual Fed chairperson themselves. And we've traditionally had a lot of academics and economists running the show over there. And we all know, having been practical traders ourselves, they have a different view and perhaps a less thorough understanding of how the market actually works and the impact and perhaps some of the unintended consequences of some of their actions on the market itself. So personally, I perhaps would like to see people with a little bit more practical trading background in the Fed itself and the Fed Board of Governors. I know that's a challenging thing. That's a lot to ask, so I don't realistically expect that to happen anytime soon. But I would like to see a little bit more wherewithal, even if perhaps I don't think that maybe day-to-day that should be the driving force of their decisions. But they should have some understanding of what the ramifications of their actions are on or will be, I should say, on the broad market. What are your thoughts here, Nick? Kind of an interesting thought question here on the Fed.
Yeah, I mean, not really being just from an opinion standpoint, not being an economist or anything like that. I think that personally they have to pay attention, because you hear them talk about soft landings and that type of thing, meaning that they don't want to do anything that's going to cause the economy to crash hard or or to bounce very hard. And you can go all the way back to when Alan Greenspan talked about the irrational exuberance of the market. Clearly, he's somebody who was paying attention to what was going on and wanted to give have people take heed in the fact that maybe they better rethink some of the things that they're doing or some of the expectation they have from the market itself. So not having a Bloomberg terminal, or there's a difference between not paying attention on a micro daily basis and knowing what's going on. So if they should at least be opening the paper and seeing what's happening, in the good old days, and say, oh, it's up, it's down, this is the expectations that people have. I think that's really important. So I think if you're an economist, you got to know about what's going on in the economy. And should they really care? No, they can't really care, meaning they can't really care saying, well, we don't want people to lose any money in the market, but they also have to, you're going to see things now along the same lines where they're talking about, they have to make sure, they have to pay attention. They have to look at the market, and the market is not just the stock market. They have to look at what the CPI and PPI are doing, right? So they have to see what the inflation expectation is, where inflation is going, what kind of jobs data there is. So they have to pay attention in order to make the right decisions about what their rate path is going to be. So yeah, should they care about the stock market per se and which direction it goes? To some extent, that has to be part of their overall economic market that they have to look and review and make sure that they're making the best decision with all the information. So it's just like information in, so they have to pay attention. So I'm going to go with the side of you got to know what's going on.
Yeah, it's a delicate balance there. They have to know, obviously. You want them to be savvy. You want them not to be completely ignorant. You also don't want a board of Fed governors that says, oh, the S&P sold off 10 handles today. We got to cut rates, So there's got to be some nuance there, level in between. But having just all academics who are completely removed from it as well is not the answer, I don't think, either. So somewhere in between is probably the level that I think we're comfortable with. But again, this is an interesting question. I love our listeners. They get us off topic on some interesting stuff all the time. Unfortunately, it's all the time we have for the futures options feedback this week. It's also all the time we have for this episode of TWIFO this week in futures options. But before we wrap up really quickly, Mr. Nick, you guys are always working on lots of cool stuff over there in the land of Quick Strike. What can our listeners expect coming down the path from you guys over there with all things Quick Strike? Any new tools, any new updates coming that they should be aware of?
Yeah, I think, it's the end of the year, like I mentioned last week, so we'll be doing some planning here for first quarter. So I think that you'll see some new tools, specifics of which I can't really put my finger on or give a good explanation, but more market-driven, helpful tools will be out there and available. You'll also see we just got the okay to start doing. We have an economic calendar out in Quick Strike and in the Essentials version, and as well as a subscription. But what you're going to see is we're going to start diving more deeply into that economic data, meaning we'll be able to price some historical stuff and do some charting and really look at some of those numbers a little bit more deliberately, maybe plot some of those non-farm payroll numbers against the volatilities on those days, that type of thing. So we're going to look at more like potentially event vol-driven stuff plotted against the actual numbers, consensus, et cetera. So, we continue to put out the good tools on the analysis and pricing of the options that are trading, but we're also looking to do more from a historical and a deeper analysis standpoint. So should have some interesting stuff coming out in 2017.
All right, stay tuned for those secret updates coming from Quick Strike over there. And on behalf of Nick and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing to the show. Don't worry, we'll get the live stream kicking next week as well, so you guys can join us live as well. Stay tuned for that, and we'll see you next week for more of This Week in Futures Options.
This Week in Futures Options is brought to you by Quick Strike, options pricing and analysis software. Quick Strike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. Quick Strike has you covered, with market data reports ranging from open interest to the term structure of volatility. Quick Strike is the perfect addition to your trading toolkit. Learn more about Quick Strike at bantix.com. That's BANTIX.com. QuickStrikeTix.com. And don't forget to follow us on Twitter at QuickStrike1. That's QuickStrike1.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.